Hello and welcome to the December edition of the WBA Legal Monthly Compliance Corner. For those of you who might be joining us for the first time, these are quick monthly updates on compliance hot topics that we like to provide to you through WBA Legal, where we can talk about some happenings in the world of compliance and those items that might be new and relevant to you since the last time. And welcome back to those of you who are joining us again. So this is, of course, our last compliance corner for the year of 2023. I hope all of you had a great holiday season and a great 2023 as a whole. And we look forward to seeing you in 2024 and what the world of compliance has to bring to us and has in store for us in the new year. So as always with these videos, we have the links provided for resources in the description below. So just in the description box below this video on YouTube. And those links will correspond to those items that are marked with an asterisk in the slides. So with that, why don't we get started with an overview of what we'll be covering for December. So on the second slide here, we have a summary of those items we have decided to cover and those new items. So first, we're going to open this time with some threshold adjustments. We, of course, had some last year, but there were still a couple we were waiting for from CFPB and some CRA as well. So we'll cover those this time in just a moment. We also have an update for you on FDIC's signage and advertising requirements. We've talked about that a couple times. We had a proposal somewhat recently, and now we have a final rule. We also have a new FDIC advisory on CRE concentrations. And so this isn't necessarily anything new as we'll talk about, but FDIC did issue this to re-emphasize some risk-based guidance that should be helpful for those of you issuing CRE. Then we have an update and discussion on FinCEN beneficial ownership information, some new items, some updates, and some resources to touch base on that. And then lastly, we'll talk about 1071, and we have a status update for you on that. So with that, we will get started on slide 3 with our first item, those threshold adjustments I had mentioned. And again, we had some last month. We had a majority of them last month that we went through and we talked about. And you'll see them in Compliance Journal as well. But we were still waiting for CFPB to issue some additional threshold updates as we go into 2024 here. And we have those now. We have HMDA and HPML. So first, talking about HMDA, this is the asset size exemption. And Regulation C, which implements HMDA, does provide an exemption from HMDA from all collection reporting for institutions of certain asset sizes. This threshold is updated annually, and for this year, for 2023, it was set at 54 million, and now for 2024, it has been adjusted to increase to 56 million, meaning that institutions with assets of 56 million or less as of December 31st are exempt from collecting HMDA data in 2024. That's December 31st of 2023, so going into the new year, would apply that threshold. Keep in mind, though, that that's just applicable then to that 2024 data, so that data that you would be collecting next year. So it regards whether you have to collect and report in the next year. So that 2024 exemption doesn't apply to data that you might have been required to then collect in 2023 under that previous threshold. CFPB has also issued threshold adjustments for the required escrow accounts. So the rule that requires escrow accounts for higher price mortgage loans. So that's Truth in Lending and Reg Z generally requires escrow accounts for certain first lien HPMLs, but it does provide an exemption, as many of you know, for certain requirements, including asset size thresholds, meaning there are certain conditions that you need to meet in addition to asset thresholds in order to obtain that exemption. So that threshold is also updated annually, and it was 2.537 billion in 2023 and has been increased to 2.640 billion in 2024. As a result, this also increases the threshold for the small creditor portfolio and balloon payment QM. So those of you who have been using those, of course, know that the threshold is referenced in that section for the criteria for making those certain small creditor and balloon QMs. Keep in mind, again, that there are additional requirements. Those requirements have not changed to be able to use that QM category, such as how many covered loans were made in an underserved area. So we're just talking about the threshold here. Only the threshold has been adjusted. Those requirements remain in place. Then lastly, you can see on this final bullet here that the Economic Growth and Regulatory Relief Act, that created, when that was signed in 2018, that created an additional exemption from HPML escrow requirements. So originally, when that came into place and was implemented into Reg Z, that applied if the institution had 10 billion or less and made 1,000 or fewer covered loans. Again, among other criteria, we're just talking about that threshold for purposes of this slide. That was increased. So recently in 2023, that went up from that original number to 11.374 billion. That was the 2023 threshold. That will now be increased to 11.835 billion in 2024. So we've now rounded out all of our annual threshold adjustment requirements. We've got all those with the previous discussion from last month. Again, we'll have an article in compliance journal as well. So you'll see those threshold adjustments, and we'll have the additional ones implemented forthcoming as well. So you'll be able to have all of those together soon enough. We have a couple other thresholds, however, not related to our truth in lending, not related to Reg Z, and not related to HMDA. We also have our CRA adjustments. And so we have FDIC, FRB, and OCC for their implementing regulations of their Community Reinvestment Act rules. So first, we have FDIC and FRB because they did, well, in short, issue them in separate rules. But the first one we have for you on the slide here is FDIC and FRB. And so they issued their final rule to adjust, of course, the asset size thresholds related to the definitions of small bank and intermediate small bank within those CRA rules. We, of course, just a point of clarification I wanted to mention at the outset of this as well. We, of course, have the new CRA rules. And again, to get that out of the way, what we're talking about on this slide here and the adjustments for this year applies to existing CRA rules. So keep in mind that, yes, new CRA has new definitions. It has new thresholds. Those will take place with the new CRA rules when that becomes effective in 2026. So the new thresholds don't apply yet. And the adjustments we're talking about right now don't affect those thresholds. So if you're looking at these new rules and trying to make sense of them and saying, well, these are going to be the new thresholds, those are still going to be the new thresholds. The adjustments that we're talking about now apply to the existing rules. So think of them separate, and we're operating under current CRA thresholds. Current CRA thresholds have been increased. Those will then be a small bank with assets of less than 1.564 billion as of December 31st. And this is the either of test. So that's either of the prior 2 calendar years. And then intermediate small bank being assets of at least 391 million as of December 31st of both of the prior 2 calendar years, and less than 1.564 billion as of December 31st of either of the 2 prior calendar years. Those are then effective on January 1st of 2024. And then as a separate item, put it off to the side, OCC issued its own update in a bulletin. Those thresholds are the same, so I'm not going to repeat them. It's consistent with FRB and FDIC, but because they were issued separately in separate rulemakings, we wanted to include both of the rules for you so that you have those referenced, depending on if you're FDIC or FRB regulated or OCC regulated. You'll be able to see the FDIC and FRB ones in its own link to the final rule in the description below, and then OCC's announcement in its own link below, so you can have that for reference. On to slide 5. So now we're talking about FDIC's sign and advertising requirements. So a bit of history. Think back to late last year. FDIC had proposed to amend its Part 328, which relates to rules for use of the official FDIC sign and advertising statements. So of course, the FDIC logo, the statement FDIC insured, those advertising when you're making an advertisement and the requirements that need to be in there. And in addition to that, and those rules that we're all familiar with, it addressed misrepresentations of deposit insurance coverage. So as we all know, FDIC has been looking at that. We've seen it, again, primarily from non-banks making misrepresentations about those products that aren't FDIC insured. And we even had seen some enforcement actions from FDIC. It's beginning to acknowledge this and see this, that, there are blatant statements, again, primarily from non-banks, that are saying, representing or otherwise confusing customers as to what may be insured. So we talked about this proposal back last year and commented on it as well. And FDIC has since issued a final rule just this month. And so, again, FDIC was looking at a few things that it wanted to address, primarily looking at reducing that consumer confusion that I just mentioned, such as those misrepresentations, misleading statements about uninsured products being uninsured, but also reconsider its advertising and statement requirements in this use of digital banking. So, of course, we're talking about mobile banking, we're talking about online banking and how these requirements apply to it. That's primarily what's going to be applying to you. But part of our comments to FDIC were, of course, that, when you're looking at these misrepresentations, understand that it's not banks that are misrepresenting, right? We've been working with these rules for some time. We understand these requirements. We understand the difference between insured and uninsured, and the importance of making sure that customers understand that. And so banks have long had procedures. You all have your disclosures set up. You all have those products separated. And when you're making advertisements for uninsured products, making sure that they're not misrepresented. FDIC does seem to generally be aware of this. So again, there is that component of the rule. But to summarize those aspects that are primarily going to be on your mind and relevant to you, and something that you're all going to want to take a look at. So if you had looked at this proposal, make sure you consider what's been finalized here and how this is going to affect your websites, your lobbies. If you have any, additional lobbies where it might now be required to have these signs, how this is going to affect you. And again, to just kind of summarize that for purposes of a takeaway from this video, and then to go back and review and look at, we've got update requirements for display of the official FDIC sign. So this is in branches. Now will include other physical premises where consumers have, and this is straight from the rule, access to or transact with deposits. So broadening that now. The idea here being is FDIC was looking and saying, well, we're getting all these different types of locations where banking is done and deposits are taken. And so within the scope of this original rule of areas where deposits are taken, kind of expanding upon that concept to include those new locations, such as FDIC gives the example of cafe type locations where we might have these services and deposits available to be taken in these cafes. The final rule also requires display of the FDIC sign on digital platforms now, so such as websites, mobile apps, and even on certain ATMs, as you'll see. It requires use of new signs specifically differentiating insured deposits from non-deposits as well. So this means a specific statement that certain products are not insured by FDIC, are not deposits, and may lose value. So again, looking at combating that consumer confusion and now having that proactive statement as to what is not covered and what wouldn't be insured from loss. It also requires a once per session notification when a customer is leaving a bank's digital deposit taking channel. The idea being here that if I'm on your deposit platform and I click a link, maybe on your website or on the mobile app, and this link takes me to a non-deposit section of your web page or even a third-party website, FDIC is saying, hey, I should get a notification of that, right? Again, the idea being to clear confusion and make it clear that this is deposits and these are insured, and this other area that I'm now being redirected to, thinking I was once on deposits, that is not being misrepresented as insured along with those deposits. So think about how that's going to affect you, right? You're going to need to be looking at these websites, looking at these platforms that you're using. If you have a vendor, for example, that is doing this, how are you able to incorporate this in? What you'll see is that FDIC has given a decent amount of flexibility. So when you're looking through this and looking to meet these requirements, there's some more specifics in the rule on how you can do this, because every website is going to be different, right? Every digital platform, mobile banking, and bank site in general is going to have its own functionality. And so recognizing that FDIC has given some flexibility. So take a look at that more specifically. You can find the link in the description below. And then I'll also add that in the final rule, it includes those aspects where FDIC is again trying to crack down on these misrepresentations. And so this is largely for clarification purposes and taking those enforcement actions, aspects of what constitutes misrepresentation. So there's a good deal of discussion in there of what misrepresentation is. And again, that's primarily going to be focused on those non-banks that FDIC is looking to combat consumer confusion. So the final rule is effective on April 1st of 2024 and does have an extended compliance date of January 1st of 2025. Moving on, as I had mentioned, FDIC did issue a advisory relating to risk management practices for institutions with commercial real estate concentrations. So this is not necessarily anything new, but it does have some key risk management practices to consider in light of the current economic environment. So the goal of FDIC here is to re-emphasize the importance of strong capital, appropriate credit loss allowance levels, and just generally robust credit risk management practices. So within this, FDIC also cross-references some joint guidance on CRE, and this is existing guidance. So this was issued in 2006, in late 2006, and they also cross-reference an interagency policy statement on allowances for credit losses, which we have talked about as that was recently revised actually this year in spring this year. And we've included both of those in the description below as well. So you're going to have the advisory that FDIC put out, but we've also put those links that they cross-reference so that you can review those as well. FDIC does encourage to continue making CRA credit available, but again, is issuing this to reemphasize those prudent lending standards. Those are all discussed in the advisory. I've included them in the slide here for your review as well. So depending on your CRE concentration, make sure to take a look at the advisory for more specifics and those companion resources, all of which is provided in the links below. On slides 7 and 8 as well, so we got 2 slides here with quite a few BOI, beneficial ownership information items for you. So we've, of course, been talking about this over the past few months in particular, both in our compliance corner and with those of you on the phone who've been working with your customers on this. And this all, just to take a step back on all this, because we have quite a few items here. All of this flows from the Corporate Transparency Act. And so one of the themes here is that this is nothing new, primarily nothing new for banks. But we do have a new rule, which will update the corporate customer due diligence requirements to accommodate the new CTA, which is coming on the horizon. So the rule we're talking about today is not necessarily anything that's going to directly affect your BSA, but it is important for purposes of CTA. And then, as we'll see, FinCEN is stating, hey, well, next we do have the CDD revision. So that's something that we do need to be mindful of and be aware of will be coming next. So the first item we have on the slides for you is this final rule, this new final rule from FinCEN. And so to put this in perspective, we've got essentially 3 rules coming from FinCEN flowing from the CTA. Last year, we had FinCEN's BOI reporting rule, which, again, we've been talking about mostly, and we'll talk about a little bit again as well here as that goes into effect in January. But this new rule we have is the one we're talking about now. And this one is referred to the access rule. So to think about it, we had last year the BOI reporting rule, and now we have this new rule just issued this month in December of 2023 being the access rule. This rule has the regulations for access by authorized recipients to report BOI information. So banks will have access to BOI, obviously, in order to meet your requirements under CDD rules, which is then supervised by the regulators and covered by this rule. So basically, this rule sets standards to protect personally identifiable information. In summary, the way to think about it is that the rule is getting at who has access to BOI and how it must be protected. That's kind of the quick and short summary in a nutshell of it. Within that, then, It creates an access framework, and that applies to circumstances for authorization by FinCEN to disclose BOI. And then flowing from that, it has to whom and when FinCEN may disclose. As part of that, there's a whole laundry list, but part of that is financial institutions. Obviously, those who might have access is for purposes of customer due diligence, but there are other aspects as well, right? So there's aspects of your anti-money laundering program, for CIP, for SARS, and just overall due diligence where you might need to obtain or verify BOI information that's then covered by the CTA and then covered by those access requirements. So the rule will require safeguards that are designed to protect that information. That means administrative, technical, and physical standpoint. But don't get overwhelmed by that, because one super basic way to think about it is that it's protected in the same way to how you would protect any other non-public personal information, and that would be under your Gramm-Leach-Bliley standards, right? So something to keep in mind is that CTA, those protections do apply to that information, but it doesn't change your BSA. It doesn't change your CDD. The final component there, of course, being that the next step of FinCEN is to undertake rulemaking to revise customer due diligence. So to then again take that step back, put everything in perspective, we've got 3 FinCEN rules, 2 of which have been issued and 1 that's yet to be issued. All of this is required by the CTA, right? So the CTA launched FinCEN into this rulemaking. That first started with the BOI reporting. Second, we have the access rule we just talked about. And next, we have a rule that is yet to be issued, but is what FinCEN keeps reminding us, saying, hey, this is what we're looking at next, is the CDD, the customer due diligence revisions. Tying into this, this is the one on the right of the slide here is FinCEN's statement for banks. FinCEN has issued 2 statements. And so the first statement is on this slide, that being for banks. The next one, I'll just jump slides quick here and show you FinCEN's statement for non-banks. So there's 2 statements, one for banks, one for non-banks, but they primarily say the same thing. So we'll just cover it here. Essentially, they're clarifications. Those clarifications being that there are no new regulatory requirements for banks, meaning no new BSA requirements. So you still have existing BSA, you still have existing CDD, still follow your CDD, but you do need to comply with the CTA requirements. And of course, still have those new CDD revisions forthcoming. But for now, still existing BSA, meaning existing CDD. It's a quick 1.5 pager, so just take a look at that statement. It's included in the link to the description below. And then next at the bottom of the slide, you'll see that we circle back to the first rule, the BOI reporting rule. That's effective January 1st. And again, that affects your business customers. We've talked about this one. We've talked about the website, but since we've been talking about that website and again, FinCEN does have great information there. FinCEN really has done a good job of keeping information available, having questions, having different media available to be able to understand this rule, again, for your business customers. But that is a resource to direct them to if they still have questions, and they continue to update it. As we've seen, it includes 19 new or updated questions. That includes just kind of general inquiries that FinCEN has been getting, the reporting process as a whole, reporting companies, reporting requirements, initial reports, updated reports, compliance and enforcement, FinCEN identifiers, and third-party service providers. So a whole slew of information on there, all on FinCEN's website. While we're on the topic of website, just thought we would mention as well that DFI actually put some information on their website as well. And again, the goal here just to be helpful, because this is not something that the state implements. This is not something that DFI oversees or has an obligation to provide this information for, but kind of acknowledging that businesses have questions on this, right? And might be misunderstanding, might be going to the state for info, calling DFI, has put that out there. And again, that clarifies to go to FinCEN to get that information from FinCEN on the website. So similarly for banks, we know when you're getting questions from your customers as well, this website is a great resource to direct them to, because that is the primary resource for any questions any reporters might have on these new requirements. And then on slide 8, here is the statement for non-banks. Again, similar message here. We include that in the description below if you want to link to that as well. But we also wanted to mention the WBA resources. And again, the context of this is that we've gotten a lot of questions from you all on how to handle the new rule. Questions of, well, what do we need to know? How does this affect customer due diligence? What do we need to tell our customers? How do we answer their questions? And so we designed these resources to address all of that. Just kind of some general concepts. Keep in mind, this rule doesn't apply to banks. Talking about the one that goes into effect on January 1st, right? The BOI reporting. It applies to those who are required to report. So those small business customers of yours. So banks not required to report on behalf of your customers. You're not required to advise them. You're not required to notify them of their obligation to report or otherwise tell them what and when they have to report. That's their obligation. They need to work with their resources that they have on that. They need to use the FinCEN resources to understand those requirements. That said, we know the relationships many of you have with your customers, and it's one where they're coming to you for advice and you want to be able to help them. So that's why we created these resources, and two of them we've created for you. One, to help bankers understand the rule, and especially its interaction to the other rules that do apply to banks, and making that clarification that, hey, we do have this new rule, right? But it doesn't change that you still got customer due diligence. Key here that they're separate. And then another one to help your customers. And again, this was designed to be customer facing. So it's something that customers want to review, or it's something you want to use internally, however you see fit to use it as a discussion or consumer facing to talk through those requirements for your business customers. But again, keep in mind that those great resources are on the FinCEN website, and directing them to the FinCEN website is a perfectly acceptable way to help direct them and give them information. Slide 9, of course, we saved this one for the end, is an update on the status of 1071. So 1071, of course, being the small business data reporting rule that we've been talking about for quite some time now, and following the progress of the lawsuit challenging it, and now the action in Congress to look to invalidate CFPB's rulemaking. So specifically an update on that action on the legislative side. The Senate did pass a resolution to cancel CFPB's rule in October, right? So this all started with Congress looking to essentially invalidate CFPB's rulemaking to implement Section 1071. That was in October. And then just recently, this month in December, the House passed a resolution as well. So it has cleared both the Senate and the House. And that resolution then went to the president. That was vetoed recently after this video will be published in mid-December, which means at that point that it goes back to Congress. And so Congress does have the option to override it, but they would need to pass that resolution with a 2/3 majority in either chamber. So again, more providing this for information, because again, we're tracking this. We're going to continue to track this. We'll continue to update as we have this. So you'll see that in the daily, and we'll of course cover it in future resources and programs and compliance corners as we talk about that. But we are still recommending that you continue with your implementation plans. Again, the rule is still valid. We, of course, have the delay that we talked about for implementation. If that applies to you, we are going to continue to track this action in the legislature as well. But again, for now, the takeaway that we wanted to give you is to continue with implementation, because there is very likely to be some form of 1071 rule, again, in some form or another. And the current one that we have is the rule that was finalized by CFPB, and we've discussed and have talked about and have resources for implementation on the website. So keep that in mind, keep moving forward with that, even as we continue to track this. We do have an asterisk for the update. That is a quick item from the White House, from President Biden, indicating his rationale for vetoing it. As expected, it focuses on the need for the government and the desire for this information and the value that can be provided and used when regarding lending to small businesses. But if you want to take a look at that veto, that's the item that you'll find in the link in the description below. So with that, as we wrap up, as always, want to include a reference to the WBA resources available to you, both on the WBA website, so compliance tools and resources. We have the links here, and we also have a link in the description below, for example, to those BOI resources. Those are the most recent updated resources that we've provided. Again, there's two of them. One designed specifically for bankers, and one designed for those business customers that we know are coming to you with questions. In addition to other publications such as Compliance Journal and then training opportunities. So if you're looking for in-house training, for example, provided through WBA Legal from myself and Heather, take a look. There's a link to more information on our website. And of course, the compliance hotline. So if you have any questions on what we've talked about, if you got questions on the BOI rule, on the access rule, on 1071, on the FDIC signage rule, or anything else that you're looking at, make sure to take advantage of our call program where you can call or email directly, and we'd be happy to hear from you. But with that, we'll wrap up Compliance Corner, and we'll look to wrap up 2023 as well, I suppose, here. And we look forward to talking and working with you in 2024. Hope everyone had a great 2023, had a great holiday season, and has a happy new year. We'll see y'all in 2024, everyone.